Now that tax season is behind us, could municipal bonds be doing more for clients than they realize, especially as the market has repriced? I'm Paul Malloy. In today's video, we'll explore how municipal bonds can be a strategic part of clients' long-term portfolio planning. I'll also break down what the recent shift in the muni market means for both you and your clients, the risks of staying too short, and how to choose the right muni vehicle to align with your client's goals. So as we look over the past few years, we've had a couple of opportunities where you can re-enter the market at attractive yields. If you missed the summer of 2023, if you missed the summer of 2025, now's another great opportunity to get back into the municipal markets. In the recent backup due to some geopolitical uncertainties, we've experienced some volatility. And that volatility has not been a bad thing. It's just put a focus on some additional risk premiums into the market. And the muni market is one of the better markets to jump into because it's far less sensitive to the geopolitical risks. So now you're getting compensated pretty well to move out the curve into the belly of the curve and take on that extra duration risk for additional returns. Especially now that we're on the other side of tax day, where we move from our CPA friends to our advisor friends who are looking to bring down some of that tax liability. The planning really starts now. And now is a great time to get into the market to start to alleviate some of those future tax burdens. So it's been something we've been seeing for quite some time is the muni investor clustering in the front end of the curve. I think it happens for two reasons. One, there's a bit of risk aversion. So the shorter in you are on the curve, the less interest rate sensitive you are. And that's fine. That can be a personal preference. And then there's been the big move to SMAs, where separately managed accounts, in order to be able to do this at scale, have just been really buying indiscriminately at the front end of the curve. And that's really driven a lot of the value out of the market because a lot of SMAs don't move into credit space. They don't push much further out the curve. That's really started to actually affect market pricing at this point. So we see a lot of opportunity in avoiding where SMAs have made things relatively rich. So in the front end of the market, we really like investment grade credit. And then we like moving out the curve to the 20-year part of the curve. We really like that because, as we like to say, the market is steep and cheap as you move out the curve. Advisors, I believe, should be thinking about what gives you the best after-tax return when thinking about how to invest in the municipal market. And as I think through what the major options are available, you've got ETFs, mutual funds, and SMAs. And to me, the ETF sticks out as by far the best option. They're highly liquid and they're highly tax efficient. The mutual fund is also a great option for buy and hold as you wait for the ETF market to continue to develop further. The SMA is my least favorite. And it's not the structure itself that I rank it lowest on. It's really the typical investment that is held within an SMA. It typically avoids short-dated credits, and it typically does not push further out the curve into places where we see significant value. So at this point, we really see the ETF as one of the best structures to access the muni market for the average advisor. Be sure to like this video and subscribe to this channel to hear from Vanguard's thought leaders.